next guest is somewhat cautious on the story of the market and the economy. Victoria Fernandez is Chief Market Strategist at Crossmark Global Investments, one of our regular guests. Great to see you. Victoria, thanks for joining us. What's your general sense of what's happening in the market right now?
Yeah, well, obviously, Jonathan, we look at the end of last year, we see that we had that Santa Claus rally coming in, and it really bumped up the markets. And we thought we would hit that all-time high before last year closed out, but it didn't. It ended up happening here in the beginning of the year. But we think we need to be a little bit cautious here. There's a lot of elements out there that are telling us that either recession is coming or we should be in recession already. And it's really the consumer that has been bucking those trends, those historical trends that we see in the strength of the consumer. So the question really is, how long does that hold out? I mean, you look at leading economic indicators, right? Historically, John, one of the best indications of what's going to happen in the economy. And we have been negative here for 21 months in a row. Typically, you look at the last 7 business cycles, you are in a recession 14 months after the peak of leading economic indicators. We are 25 months past that right now. So we just think you need to be a little bit cautious because there are red flags. There's geopolitical issues. We've got 80% of the global market cap that's going to be involved in an election this year. Obviously, we have a big primary going on in the United States today. There's just lots of elements that are out there. And I think the market got ahead of itself in pricing in some of the rate cuts that they were expecting, not just in the U.S., but you hear it coming out of the European markets as well, the ECB pushing back on that. So there's going to be some repricing and some volatility we need to be aware of.
And as I mentioned, we'll see what the Bank of Canada says this week on their road ahead on interest rates, all this central bank language, the market watching closely. Given everything you said, if someone is putting money to work in stocks in the equity world right now, what's the kind of strategy you think makes the most sense?
And John, this is really important. I want to make sure that everyone watching understands, just because we're cautious does not mean we are out of the market. We do think you need to be in the market. So where are we putting money to work for our clients? Obviously, we still have money in the U.S. markets and the equity markets. We think you just have to be a little bit cautious and look for areas that maybe are having some relative strength versus the rest of the market. You look at the S&P as a whole for the first couple of weeks of this year through the middle of January, it was only up, or the S&P was up about a quarter, maybe 0.3%, where the equal weight S&P was down 2%. So where can you find some advantages? Financials are having some relative breakouts, so maybe look for some opportunities there. I think healthcare is the same. You're starting to see some transition there. So on pullbacks, maybe look there. But you don't just have to stay in a domestic equity market. Look at fixed income. There's still a lot of opportunity there on the short end of the curve. If you're looking for income and cash flow, you can do that. You can lock in some longer rates if you have a longer term perspective. And there's other ways to generate income. You can use options to do that as well. With volatility in the market, that's a great way to do it. And we are dipping our toe internationally as well. I think if you start to see the Federal Reserve lower rates before other central banks, you'll see some cash flow into other areas of the world, and I think you can maybe participate in that a little bit.
Now, financials as a subgroup within our Canadian stock market make up more than 30% of the index. That's actually a much larger weighting than in the S&P 500. Can you just walk us through, given some of the economic considerations you highlighted, just, if we're watching where the economy goes from here, what does history tell us about how these banks might, or these financials might perform in an environment like that?
Yeah, so obviously, if you think you're going to have a deep recession, financials is not where you're going to want to be, but we don't see that. We see a pullback, maybe a larger pullback or a very mild recession coming into play, but with a consumer that is continuing to support the economy, they're continuing to purchase. And so credit cards are doing really well. Visa made an all-time high yesterday. When you see some of these stocks make all-time highs, though, John, trim a little bit of those names, take some off the table, go into some other areas of the financial markets. We do like some of the larger banks. Our theme is always strong balance sheets, right? Look for those that have good, solid earnings, predictable earnings, and strong balance sheets. Banks fit into that category. So you have like a Bank of America or a JP Morgan is a good place that you can put money when you think there's going to be some volatility in the market, because that cash balance and those ratios they have will support them. And some of the other credit cards, even though we're seeing delinquencies rise a little bit, you look at a name like American Express that caters to a higher earning customer, they're still doing pretty well. So I think you can put some money to work in a credit card like that as also.
All right. Thanks for